Welcome all. So, after just initiating the discussion on the cash flow estimation about the replacement projects, now we will learn practically how we calculate or how we estimate the cash flows for the replacement proposals. And here is one more problem, the third problem with regard to the estimation of the cash flows. So, first we will read the problem carefully, understand it, what is the information given here, and then we will see what important things have been taken into account for calculating or for estimating the cash flows in case of the replacement projects. So, for example, this information given here is say Ojas Enterprises is determining the cash flow for a project involving a replacement of an old machine by a new machine, replacement of the old machine by the new machine. So, in this case the old machine bought a few years ago has a book value of the 400,000 or the 4 lakhs rupees, 4 lakhs, and it can be sold to realize a post tax salvage value of the 500,000 or the 5 lakh rupees. It has a remaining life of 5 years, after which its net salvage value is expected to be 160,000 rupees. 1,60,000 rupees. It is being depreciated annually at a rate of 25% under the written down value method. The depreciation is 25%, the written down value method is going to be followed, and the rate of depreciation will be 25%. The working capital required for the old machine was rupees or is rupees 400,000 rupees. It means the book value of the old machine is 4 lakh rupees and the working capital required for the old machine is 4 lakh rupees, right. The new machine which is going to be now added as a replacement of the old machine, the new machine costs 16 lakh rupees, 1.6 million rupees, 1600,000 rupees. This is going to be the cost of the new machine. It is expected to fetch a net salvage value of the 800,000 after 5 years when it will no longer be required. Means the machine will be purchased today as a replacement of the old machine, we will shell out 16 lakh rupees, 1.6 million rupees, we will use that machine for a certain number of years, and after that it will be sold as a maybe a second hand machine in the market or maybe as a salvage value for the firm or whatever it is at the 50% of the purchase price, and that is at 8 lakh rupees after 5 years. It is given here after 5 years. So, it means there is a possibility of the use of the machine for the next 5 years. After 5 years we can dispose of the machine at half of the price of the purchase value, and that is at 8 lakh rupees. The depreciation rate applicable to it is 25% under the same written down value method, because in India it is compulsory that the say the depreciation for the income tax purpose has to be calculated under the WDV method, not under the SLM method, right. The net working capital required for the new machine is rupees 5 lakhs. The net working capital required for the new machine is rupees 5 lakhs. The new machine is expected to bring a saving of 3 lakhs annually in the manufacturing cost. This is the major point. Why we are going to replace the old machine with the new machine? Because it is more efficient, it is more effective, it is going to say bring us or cause us the savings worth rupees 3 lakhs annually as compared to the old machine in the manufacturing cost other than depreciation, right. The tax rate applicable to the firm is 40%. The tax rate applicable to the firm is 40%, right. So, in this means what is required to be done now? Given the above information, we have to now say estimate the cash flows, but here the cash flow which you will call it as in case of the replacement projects, the cash flow estimation or whatever the cash flows we estimate are called as the incremental cash flows, are called as the after tax incremental cash flows, which are associated with the replacement project, right, which are associated with the replacement project, right. So, means why we are going to change the machine? Because some cash flow is going to be available with the old machine also, but we are going to have the better cash flows, higher cash flows. So, it means net result is that we are going to have the incremental cash flows. So, that is a one more correction here we have to do, that in case of the replacement projects, we do not evaluate it as a standalone proposal, or maybe addition to the existing project or the existing say series of the products. It is the same project, same manufacturing process, everything, only what we are going to do here is we are replacing the old machine with the new machine. So, it means when the old machine is there, some cash flow is coming at that time also, but in case of the new machine, additional incremental cash flow is going to be there. So, that if you calculate the after tax cash flows, that is going to be more as compared to the cash flows coming from the old machine. So, the net result here is we have to work out the incremental net cash flow, and that is after tax, right. So, for now calculating or working out or estimating of the cash flows for the replacement projects, it is done here already, it has been done. So, we can save the time also. One problem, first one was like this, second we did ourselves, and then now this third one in case of the replacement projects is given to us here. So, we can just look at it, that how the cash flows have been worked out, or in case of the replacement projects how the cash flows are worked out. So, again we are taking the same thing here, we have taken the years on this side, and then this is on the years on this side, or you can call it as a particulars also. This side is a particular, this side is a years, and now we are taking the same number of years. The functional years are 5, 1, 2, 3, 4, 5, and the current period is called as the 0 period, and in the 0 period we will estimate largely the cash outflows, and then in the subsequent 5 years we will factor for the cash inflows, and then the net cash flow will be worked out at the end of this entire process, right. So, in the 0 period, in the 0 year, in the current period, what is going to be the, say we will have to first of all calculate the investment outlay. This is the first requirement. Number 1 is the investment outlay, which we are going to work out here, and this is something like, you call it as, the first thing is the cost of the new machine. What is the cost of the new machine? It is given to us, that is 16 lakh rupees. Since we are giving rupees in thousands, so it means it is 1600 thousands or 16 lakh rupees or 1.6 million rupees. Number 2 is now the salvage value of the old asset, because we are, when this is an old asset is going out, we are going to have some salvage value of the old asset, and that is 500 rupees. So, this figure is positive, it will come and 16 will go, right. Increase in the net working capital will be 100, because net working capital required in the old machine was 400 million rupees. In this it is required as the 500 million rupees. So, it means the net working capital is going to increase. So, when the net working capital is going to increase because of say the new machine, so it means that increase is going to be how much? By 100 million rupees. So, total investment if you work out 16 plus 1 17 minus 5 is going to be the 1200 thousands. 12 lakh rupees actually the net investment is required. Total net investment required for this replacement project is 12 lakh rupees or the 1200,000 rupees, not 16 lakh rupees or 17 lakh rupees, because some cash inflow will be available from the sale of the old machine or liquidation of the old machine, right. Now, we go to the point number 2. Point number 2 here is, that is operating say estimation of the operating inflows, and now because we have to work out the operating cash flow. So, we have to now take here into account the operating cash inflow and cash outflow. So, on account of revenue the inflow will be there, and on account of different expenses cash outflow will be there. So, we will have to work out the net cash operating cash flow. So, for calculating the net operating cash flow, it may be outflow also, it is not all the times inflow, because if the revenue is lesser and the cost is more, so it will turn out as a negative cash flow. So, I am calling it as the cash flow, not the cash inflow. So, what is the operating cash inflow from the project? Operating cash flow from the project is going to be, say here now we will not talk about the revenue, we will talk about the savings, extra savings. So, it is clearly given in the proposal. If you look at the information given in this PPT, it is clearly given the new machine is expected to bring a salvage value of 3 lakh rupees annually, and this is more important. This is the source of revenue, because old was also giving you revenue, old also had the cost, new machine is also giving the revenue, and new machine also has the cost. So, what is the net difference in terms of savings? What is the net difference? That is important for us. And here if you look at this, so savings is how much? Saving is, we are taking here after tax savings in manufacturing cost. After tax saving, it is clearly given here, that is the new machine is expected to bring a saving of 3 lakh rupees annually in the manufacturing cost other than depreciation, right. So, what is the after tax savings? Because total savings, on that we have to pay the tax also. So, what is the tax rate? Tax rate here is the 40%. So, what is the total? 3 lakh rupees we are going to save, and minus 40%. So, it means finally we are going to have with us is the 180, 180, 180 and 180 here, right. So, this is the after tax savings in the manufacturing cost, first source of revenue, and then extra cost. We are going to have the depreciation of the new machine. So, what was the rate of depreciation given? Rate of depreciation was given here as 25%, and what is the cost of the machine? 16 lakh rupees. So, 25% of 16 lakh is 400,000, 300,000, because it is a written down value method, 225, then it is 168.8, and then it is 126.6, right. This is the on the new machine, but there will be the depreciation on the old machine also. So, adjust for the depreciation on the old machine. What is the depreciation on the old machine? If 25% is the rate again, and then the method is also the WDV. So, it means that old machine was costing to us was how much? 400,000, and 25% of that is 100. So, similarly the depreciation for the old machine you have to work out. Now, how much is the incremental depreciation? Everything is incremental in terms of the revenue also, in terms of the cost also, because depreciation we were paying earlier also, depreciation we are charging now also. So, how much is the incremental depreciation? So, this figure is important for us, this is the important figure for us. So, it is called as incremental depreciation, and if you take this incremental depreciation, it is 300, 225, 168.7 million, 126.6 millions and 95 million rupees. Tax savings on the incremental depreciation, because when you show this depreciation in the profit and loss account, how we call it as a tax saving? Because when you show it in the profit and loss account, we are talking it about as the, this is your profit and loss account, and you write here as the one cost is the 2 depreciation, and finally then we calculate the 2 PBT, profit before tax, then we talk about the 2 tax, and then we talk about the 2 profit after tax, right. This is the process. So, when you are showing this as a cost, it means profit before tax will come down by the depreciation amount, and when the PBT is lesser, so certainly the tax due on the profit before tax will also be lesser. So, but basically it is a non-cash expense, it is not a cash expense. So, that is a very important point, because it is different from the normal expenses. So, here that is why we are calling it as tax savings on the incremental depreciation will be this much 120, 90, because tax rate is 40%. Tax rate is 40%. So, 90, 67.5, 50.6 and 38, right. And then lastly net operating cash flow. Net, it is written here inflow, but always you say that net operating cash flow, because it can be negative also. If that revenue is negative and the cost is more, or the revenue is lesser and the cost is more, then the inflow will become negative, or the cash flow will become negative, not inflow, cash flow will become negative. So, in this case what is the situation? Then cash, this is tax savings, and finally net operating cash flow is how much? 300,000, because it is the total amount which is available with us 5, the column number 5 plus 9. So, 5 is, this is the after tax saving in the manufacturing cost is 180, and 9 is going to be the tax saving. So, these two will become as the 180 plus 120 will be 300. So, this will be known as a net operating cash inflow. So, if you look at this process of calculating or estimating the cash flows, and if you look at the previous process in case of the new projects or expansion projects, if you look at the cash flow analysis, totally different. In this case, source of revenue is only the differential savings, right, in the manufacturing cost, and then only we are calculating the differential amount in terms of the outflow also, in terms of the inflow also, in terms of the sales also, in terms of the cost also, what is the differential amount. So, the process is a little different as compared to the process we followed for the previous things. Now, tax savings and then finally the net operating cash flow we have calculated here. Third important point here is now to calculate the terminal cash flow. To calculate the terminal cash flow, because ultimately we have to calculate this fourth item which is called as the NCF, net cash flow. For calculating the net cash flow or NCF, you have now to calculate the terminal cash flows. Terminal cash flows are net terminal value of the new machine is how much? 8 lakh rupees. We have already seen information is given that it is say 50% will be realizable on the sale of the new machine after 5 years, because we are going to use the machine for 5 years, maybe the life of the project is 5 years. And net terminal value of the old machine is, it is given to us 1,60,000 rupees. It was purchased for 4 lakh rupees and terminal value is going to be the 160,000 rupees, right. And next source of the say terminal value will be recovery of the incremental net working capital. Recovery of the incremental net working capital. So, how much net working capital we are going to invest more here? Earlier case was 400 millions, now it is 500 million. So, it is the extra amount of the 100 millions which we are going to recover back in full. So, finally, terminal cash flow is how much? This has been calculated as 11 minus 12, right. 11 minus 12 means the cash flow from the new machine, terminal value from the new machine, but if it was not there and only old machine was there, then we could have got 160 in that case also. So, incremental terminal value is how much? That is 800 minus 160 plus the working capital part 100. So, the total amount here we are getting the terminal cash flows is, total terminal cash inflow is 740. And finally, here if you look at, then we have calculated the NCF, net cash flow, which is a sum total of the column number 4, 10 and 14. So, column number 4 is this much, because we are only not talking about the inflows, we are talking about the outflows also while calculating the NCF, net cash flow. So, in this case we are talking about this also. So, 1200 is the outflow, right, because not 16 but 12, and inflows we have calculated here. So, we have taken the 4 plus 10 plus 14, 4 is this, 10 is this and 14 is this. So, in the 14 is important because we have to take into account the terminal value also in calculating the net cash flow. So, it means here in the first year the major source of the net cash flow is the operating cash flow, second year also operating cash flow, third year also operating cash flow, fourth year also operating cash flow, and fifth year is sum total of the operating cash flow and the terminal value. Operating cash flow and the terminal value is going to be the net cash flow in the year 5, which is 958. Out of this 740 we are going to get as the terminal cash flows, and the operating is how much? 218. So, this plus this figure, this comes out as 218 plus 740, this becomes 958. This becomes 958. So, this is how the cash flows for the replacement projects are worked out, and this process is entirely different from the process which we followed in the earlier cases. In the first case we saw that the proposal is the standalone proposal or it is a new investment proposal, everything is constant, your cash outflow is constant, cash inflows over the foreseeable period are constant, and then we calculated the net cash flow, we estimated the net cash flow. In the second problem we saw that it is a addition of the one more product into the existing 16 products, and in that case when you are adding, so there are some problems of like bad debt losses, the problems of opportunity cost, and we learned there. And then the important consideration there was that we assumed that cash inflows are not going to have a straight line, they are going to have a zigzag line of kind of the structure. We have the one amount in the first year, then it is going up, remaining stable, or again going up, then coming down, coming down. So, it means this kind of the cash flows are going to be there, cash inflows are going to be there because of the changing value of the sales and the revenue. So, we adjusted those problems there in the second. Third one was a totally different, which was with regard to the estimation of the cash flows for the replacement projects, right. So, in the replacement projects, always bear in your mind, we have to calculate the incremental figures, differential figures, and in that case we are going to take both advantages and disadvantages of replacing the old machine with the new machine, replacing the old asset with the new asset. So, if you are taking about the advantages, increase in the say savings in the say manufacturing cost, or maybe change in the working capital requirement, or change in the say sales value, all fine, these positives are there, but if this machine is not replaced and when you remove this machine, some negatives also we have to means keep in mind, bear in mind. So, that is a very important question. So, both advantages and disadvantages of replacement of the old machine with the new machine have to be kept in mind, and then finally we have to calculate the cash flows, which is basically based upon the incremental analysis or the differential calculations. So, that major difference is there in case of the traditional projects, or the maybe the difference between the standalone projects cash flow estimation or addition into the existing range of the products, and in case of the replacement of the old asset with the new asset, right. So, this is the means entire process available here. So, I will do one or two more problems also in the next classes, but in the meantime one more concept is here to be known here, which is very important, and that concept is of the inflation. And before that, one more concept here is, that is about the biases in cash flow estimations. So, let us know about these two important concepts, biases and then the impact upon the impact of the inflation on the cash flow estimation. After talking about these important corollaries of the cash flow estimation, I will do one or two more problems here, so that you are thorough with the entire process of estimation of the cash flows for the capital investment projects. Now, we talk about here the biases in the cash flow estimation. Whatever the cash flow estimation process we saw here, we learned here, in the real life we commit some mistakes, and when you commit the mistakes in estimation of the cash flows, because mind it, project has not come into the picture at the time of estimation of the cash flows, it has not come into picture, it is not really there on the surface, it is only estimation, it is only the DPFR, preparation of the DPFR, and whatever the value of sales and demand we have analyzed or found out in the DPFR after the market and demand analysis and the technical analysis, on the basis of that we are only estimating, and when we are only estimating for something which has to be done in future, in that case mistakes are bound to happen, biases are bound to exist there, right. So, what kind of the biases could be there, what kind of the mistakes could be there? These are divided broadly into two parts: overstatement of the cash flows, understatement of the cash flows. Sometimes we become very optimistic, very positive, and we say that cash flows are going to happen as per our expectations. Sometimes we become very pessimistic and we commit some sins, some mistakes, that the estimated or expected cash flows give us the lesser than the say the real values, or the say the optimistic, or you can call it as the optimum figures. What could be the reasons? First thing is overstatement. Why? Intentional overstatement. Sometime because we want to get project approved from every source, especially in case of the startups, in case of the new projects, or when the firm is coming up for the first time into existence. So, what we do to impress upon the venture capitalists, private equity providers, angel investors, or maybe sometime for borrowing the fund from the financial institutions, we exaggerate the say cash flows. So, intentionally we do it because by hook or by crook we want to get it approved. Lack of experience. Who is the person who is estimating the cash flows? Who is the person who has gone for the market and demand analysis and technical analysis? What is their experience in the field? If they are not experienced people, so what is going to do? What is going to happen? That because of the lack of experience, we are sometime going to put ourselves into the problem of the overstatement, and it is always bad. So, lack of experience can be the second reason. Myopic aphoria. Myopic aphoria is basically a term of psychology which you can call it as, in other way around, is the polarization effect. Because there is a team of the people, when the people who estimate the cash flows, they are a team of the people, it is not only one person. So, if the one person in the team says that no, the sales in the next 5 years will be this much and our cash flow will be this much. So, sometime other members of the team also subscribe to that statement, that idea, and this means the team gets polarized. They start moving in the same direction, they start thinking in the same direction. So, it is not the opinion of the whole team originally it is the opinion of the one member of the team, but later on everybody agreed to that somehow, and they agreed to what X has said out of the 5 or 6 members team, and everybody said that yes, the cash flows will be this much, or we agree with the figure which is coming out, or all the figures coming out for a period of next 5 years. So, this is called as the myopic effect or the say polarization effect. And last one is the capital rationing, because everywhere, if you, for example, if it is the say addition of the new project by the existing firm, then it may be possible that the capital for the new project in the new project has to come from the existing firm. So, sometime there might be a team of the people who want to by anyhow get this project approved by the top management of the firm, because capital is limited with the firm also, because finance is always scarce resource. So, what they do is they overstate the cash flows, they impress upon the top management of the firm that if we take up this project, then certainly we are going to have the better output or the better cash flows. In many cases, when you even have to go to the venture capitalists, private equity providers, or the venture capitalists, even to the financial institutions, we know that venture capitalists also has the limited resources, and they always select the best projects which are going to give the higher cash flows or cash inflows. So, they always exaggerate it to influence upon the venture capitalists that our project is very good, and from the limited stock of your capital, rationed capital, you give us the desired amount of the capital and you fund this proposal. So, these are 4 important say component, or maybe you call it as the reasons where we can overstate the cash flows, and they are basically because of the biases towards the project, or maybe because of the estimation in the or you can call it as an error in the estimation of the cash flows. Similarly, if there is a overstatement, there is a possibility of the understatement also. And in case of the understatement, why we understate it? Number 1, salvage values are underestimated. Now, in the previous case we have seen that the salvage value of the machine which is purchased for 16 lakh rupees and used for say 5 years will be sold for half of the price, 8 lakh rupees, or the first machine which was purchased for the 4 lakh rupees, salvage value will be 160 lakh rupees. It may be possible that the machine may be sold for the higher price, right, because when you are charging the depreciation on any fixed asset, you are simply talking about the technical value of that asset. So, depreciable value is different value, actual reduction in the value of any asset is a different value. So, sometime the salvage value which we have estimated can be much less as compared to actually that asset can fetch from the market at the time of its replacement or the termination of the project. So, one reason could be the understatement of the cash flows. Then second is intangible benefits are ignored. Now, for example, when you are coming up with the project, there could be the say intangible benefits also. There could be the intangible benefits also, that say for example, there is the increase in the goodwill. If we do a good kind of business or maybe the appreciable kind of the business. So, sometime when we are supplying a good quality product in the market at a very reasonable price or at a very competitive price. So, it creates a goodwill in the market, and when it creates a goodwill in the market, so more than the expected number of the people start buying the product, and that we have not estimated. So, it means your sales increase. So, intangible benefits, what happens, that though it is a tangible benefit, but coming out because of the intangible effect of the goodwill. So, sometime we forget to estimate it, and that causes the understatement. Last point is value of future options is ignored, value of future options is ignored. For example, now I give you the example here how this factor causes understatement. What is the written here, that value of the future options is ignored. So, what is the future option? For example, some company or some say group of the investors, they propose to construct a hotel, they want to establish a new hotel, construct a hotel, and they have the two plans, that initially we will construct a hotel which is for the residential purpose, right, but later on we will add a very good quality restaurant also to the hotel. But currently when we are estimating the revenue, and that addition of the restaurant is immediately after 1 year or 2 years. Now, we are not going to wait for a very long period of time. Currently it may be possible that the people who are going to construct the hotel, they are say not very experienced in the restaurant business. So, they want to just gain some experience, and then they want to see also that let us see how many people come and stay in our hotel, what is the occupancy rate over the number of 1 or 2 years, and then we can see that if we add up the restaurant also in this hotel, can we increase the occupancy rate or can we increase the revenue of it. So, tomorrow what happens, that we had estimated the cash flows of the hotel as a standalone facility, but later on after 1 or 2 years when we added the restaurant also in the hotel. So, it means people who were earlier not staying in the hotel because there is no food facility available in this hotel, but later on when you added the restaurant also. So, what may happen, people who are not staying in the hotel, they may also opt to stay in the same hotel. So, the occupancy rate which was estimated to be 70% at the time of the estimation of the cash flows, that may go up to 90%. So, what will be there? We have ignored the value of the future options. What was the value of the future option? The future option is adding the restaurant in the hotel. So, when people get the same, means the food facility also in the same hotel, so they prefer to stay in a hotel where the restaurant is also there, the room service is also there, and in that case it does not give you the additional revenue because of the additional service you are giving, that is of the food and restaurant, but the occupancy rate of the hotel also increases because that limitation which was causing the lesser number of people occupying the rooms in the hotel, that has been removed, right. And now more occupancy, more number of the people, more footfalls are there, and more people are coming and staying in the hotel. So, all these options we have to bear in mind. So, because of these, some factors listed out here can cause overstatement of the cash flows or understatement of the cash flows. There could be other reasons also which are not listed out here. So, we have to be very careful, more rational, more say not optimistic, but optimum in say estimating the cash flows, so that whatever we are going to estimate, that is more realistic, that is more acceptable, value adding, and more reliable, right. So, this is all till now what we could discuss about the estimation of the cash flows. First we learned about conceptually how to estimate the cash flows, then we did 2-3 problems in the different situations, that how to estimate the cash flows if this thing is there or that thing is there, or the replacement replacement project is there. And then we are now we are through with these biases which could cause the errors in the cash flow estimation, maybe in terms of the overstatement or in terms of the understatement. So, one more concept is there, that is the effect of the inflation on the cash flow estimation, that is how to adjust for the inflation while estimating the cash flows. This particular component and some more problems, 1 or 2 more problems on the estimation of the cash flows, I will discuss with you in the next couple of classes. After that, we will close the discussion on the estimation of the cash flows and move to the next topic. Till then, thank you very much.